Boa tarde a todos. Como sempre, é uma honra a gente estar aqui com o Jay Peloski. Hoje, segunda-feira, dia 20 de setembro de 2021. Temos bastante coisa para falar, quer dizer, muita coisa acontecendo no cenário internacional, muita coisa que o Jay já havia falado. Então, vamos lá, sem muita enrolação, a gente passa para ele e vamos get cracking. So, Jay, it's great to have you once again. It's a pleasure. And, of course, we have lots to talk about today. There's some great stuff, in the musings. So why don't we go straight to what, everybody's asking, everybody's talking about. So let's talk about Evergrande. I understand, we spoke to a lot of people on China this weekend. So, I'd love to hear what you have to say.
Great. Thanks, Roberto. And yeah, it's been certainly one of those days, right? I mean, everyone was talking about how long it's been since the S&P was down 1% or something. And so today we were down 2%. So quickly we can get rid of all those types of records. But yeah, let's talk about Evergrande. And I think it's important to set the stage here. And first and foremost is this is all driven by the government. Right. I think that's the most important point. This is not some uncontrolled thing that just happened in the markets and the government's completely caught unaware. No, it's the exact opposite. Property has been kind of the big elephant in the China growth story for years and years. And in fact, it was a year ago, a little bit more than a year ago, in August 2020, when the government laid out the 3 red lines for the property market and for the developers. Namely, that they were caps on the liability to asset ratio, the net gearing ratio, and the cash to short-term liability ratio. And so over the past year, the entire property sector, of which Evergrande is one of the biggest, all the developers have been trying to get under those red lines. Most of them were over the red lines. In other words, were excessively levered. Prior to the government saying, hey, guys, here's how we're going to move forward. And as we've seen in the last couple of weeks with all the other things going on in China, whether antitrust or social inequality or tutoring, when the government says something, clearly this needs to be paid attention to. So this is not it's not a news story. B, the government is driving this process. And C, Evergrande has been aware of this and has been trying to deal with it and get their financial house in order. The problem has been that they have not been successful in getting their house in order. And so they are still under the red lines in 2 of the 3 cases. And so they're essentially an illiquid property company at this point, not insolvent. Importantly, I think that's an important point. And so the issue here is that there's going to be some resolution. I think it's important to note when you're talking about the market action today, to note that China was closed today. So part of the issue is that the things that one wants to trade has not been able to be traded. So you've seen action in lots of other things like Hong Kong, et cetera. But there will be some sort of a government imposed decision. We all know that Evergrande owes a couple of notes coming due this week. How that will be dealt with will remain to be seen. But I think it's already had its effect on the markets. And so I don't think, importantly, the issue for us should be contagion. And here I think it goes back to that point that the government has set the 3 red lines in place. The government knows that Evergrande is in trouble. The government has had the various banks stress test their books to assess the risk of Evergrande. It's important to know that all of Evergrande's debt is already trading at distress level. So this is not something that came out of the blue, right, and was priced at a BB credit and then just collapsed. No, this is already trading at distress levels. And so
I think the yield is like 60%, right? Yield to maturity, right? On the debt, which is paying the interest this week. So, everybody knows it's defaulted.
Yes, it really doesn't matter that much. I think if you look at China high yield, the average, I think, is now 14%. I think you want to look at the financial sector. And here, as I understand it, JP Morgan and others have done some good work The total property loans in the banking sector is equal to 6% of loans outstanding. Non-performing loans are less than 2%. To put that in context, the last time China had a huge property bust was back in 2005, and NPLs peaked at 9% back then, 15 years ago. It's also worth noting that the H shares in Hong Kong, so the China stocks that trade in Hong Kong are back to their 2005 levels. So it's amazing. You're already there. Again, like, that's what I think an important point. You're already there. So I think it's, as I see it, it's a known story. It's a government-sponsored story. It's actually quite similar to what's happening in the steel industry, right, where the government has mandated that steel production should be flat year over year. And so production has been declining because it's ahead of year-ago levels at this point. And as a result, you've had the knock-on effect in iron ore prices, which have collapsed, down 38%. Iron ore is down 9 days in a row. I know this is something important to the Brazilian market with Vale and others. But the point again here is that it's been down 9 days in a row. It's been the last time it was down 9 days in a row. Iron ore was 6 years ago. You have had a 38% pullback in iron ore prices in the last month. You've had a 15% pullback in copper prices. So a lot of, I believe, of the price damage has been done. So I think the contagion, through the banking sector in China, is unlikely. You've already had contagion in the property sector. There have already been 5 Chinese property developers that have gone bust this year, defaulted on about $8 billion worth of credit. Evergrande, as I said, there is going to be some sort of, whether it's a technical default or a standstill, or there'll be some sort of process here in the next week or two. But I think from my point of view, the risk of contagion is quite limited, whether to China more broadly. And I just would make a note that the main China ETF, MCHI, is back to the levels that it hit about a month ago in the midst of all the concerns about what the government was doing with its various edicts. We're right back at those levels. Importantly, we haven't broken those levels. And I'd make a note that furthermore, the S&P is back at those same levels that were hit in the middle of August, and then in the middle of July, when the Delta variant was discounted, in my view. So we're back. We've hit all the way back to these levels, which I think importantly suggests that we have priced a lot. And I think before I stop, I'd just make 2 points that are worth considering in terms of potential positives out of all this. One is that in the Chinese market, there are very few places for cash to go. It can either go into the property market or into the equity market. If the property market is not attractive at the moment, perhaps the silver lining might be that money starts to go back into the equity market. The other point is that if there's a government out there that is not shot all its bullets in terms of fiscal and monetary stimulus, it's China. China has plenty of room to cut rates should it need to, plenty of room to stimulate the economy should it decide it wants to do so. Interest rates, as we know, in the 10-year are 150 basis points or more above the U.S. 10-year, for example. So China has bullets should they decide they need to use them. And then finally, I think it's fair to say, and we'll get into this in a minute, that this has been kind of a capitulation day trading-wise. In the U.S. And so we've probably gotten rid of or discounted a lot of all the uncertainty that has been swirling around, whether it's Evergrande or the Biden infrastructure plan or the debt ceiling or the Fed or any number of things that, investors have kind of been mulling over the last couple of weeks. So I think that's an important point as well.
No, this is fantastic. And there was, I don't know if you read, the author's column on Bloomberg today. I think it makes an interesting point, which is comparing, some people are comparing these to Lehman, but I think this is, way, absurd. And this is more likely, comparable to LTCM. So, definitely it's not a Lehman moment. for the reasons you have said. And a lot of people have pointed to the fact that this is a capitulation day in the U.S. So let's see what happens when China opens tomorrow. So relating to this, and talking about opening, and the other thing I wanted to bring is that this happens at a week where you have several risk factors being brought into play, right? So you have the Fed. People are nervous about the Fed. There is the energy crisis in Europe, which could be brewing up. I mean, does that magnify the effect? And it looks like we're more towards the end. Is that the case?
Yeah, I think you bring up a great point, Roberto. Yeah, this is one of many issues that people are wrestling with, and I think it's important to set the stage. And I did set the stage a little bit with my Friday musings, right?
Yeah.
It's titled "Back to the 1990s," and that's more from the strategic point of view, which I know we'll get into in a little bit. But I also talked about the tactical outlook, perhaps maybe more sanguine than today would suggest, for sure. But I talked about a couple of things, and I'll just reference them for the audience today. Again, this is today. This is prior to Monday's trading in the U.S. or anywhere. The AAII Bull Bear Survey in the U.S., which measures individual sentiment, was already at a bearish point. The 6 top tier 1 banks have all called for a correction, again, prior to this weekend. The average, here's a couple of really interesting statistics. The average New York Stock Exchange listed stock, so the New York Stock Exchange composite, is off 18% from its 52-week high. Again, before today. The average NASDAQ stock, this is amazing to me when I read this. The average NASDAQ constituent stock is off 27% from its 52-week high already before today. JP Morgan makes the point in some of its work today that U.S. cyclical sectors, namely the banks, energy, and materials, are off anywhere from 10 to 30% from their Q1 highs. And yet their forward EPS estimates have increased anywhere from 25 to 50% in that intervening 6 months. So stock prices have gone down, earnings have gone up in the major cyclical sectors in the United States. Furthermore, in Europe is now trading 1 standard deviation cheap relative to the US on a forward earnings basis, one of the more attractive rates in some time. And you have a situation where you have then today, so that's the stuff, that's the setup for today. Bull bear, already bearish. Bank of America expectations very low, back to spring 2020 levels in terms of growth in earnings, their big fund manager survey. The average stock off 20%. The cyclical stocks cheaper and generating more earnings than they have in a considerable point of time. Yeah. That's the setup going into today. So then here's today. Today you had on the tick ratio, which is stocks going up versus stocks going down, you had the second worst rating in 31 years. Okay, you had so many stocks falling this morning that it was a second worst tick ratio reading in 30 years. I should also mention, by the way, that AAII bearish survey sentiment was the second sharpest decline from bull to bear in 30 odd years. I think it's 34 years in that case. And that was, again, prior to today's trading. So you had a tick ratio, today's trading, capitulation level. You have the RSI, the short-term RSI in the U.S. hitting 31, the first time it's hit low 30s this year. You have Europe trading back to July levels, back to levels 2 months ago. And you had, as we know, this week is traditionally not a great week for returns, the week post the September option expiry. So all this is kind of in the mindset. And you're now very close to those levels that we hit back in July when we were discounting the delta. So when you put all those things together, I think you can get a sense that there's quite a bit of bearish sentiment now fully expressed between what I suggested was in place prior to the weekend and prior to today's trading. Now coupled with today's trading, I think that's quite a bit of bearish sentiment. The offset to that, which I think is important, is the following. And I made these points in the musings. The first is that the Delta variant is fading. Absolutely no doubt about that in the United States. Even in the worst hit states, case counts are down by roughly a half. Japan, there's some talk today that Japan may end its lockdown later on this month, which would be very, very helpful, particularly for the Asian reopening trade that I've been talking about for the last couple of weeks. I don't see Evergrande doing anything to derail that reopening process in Asia, by the way. You've had better economic data in the U.S. after a couple months of pretty subpar data. Last week, you had the August retail sales better than expected. You had the Philly Fed better than expected with some really good news on the supply chain front, where inventories rose, delivery times fell, open orders fell, those types of things, suggesting that maybe we're at the beginning of fixing some of the inventory reopening on the U.S. side. And then if we get the Asian reopening, which is where the production of the world, right, the factory of the world is located, then maybe we get some better news on the supply chain. You get lousy sentiment, as I referenced with the AAII. You had weak expectations, as I referenced with the Bank of America Manager Survey. So that was the setup going in here. And I think it's important to note a couple of other points before we stop here. The first would be that we've had rates backing up in the U.S. The 10-year is backed up each week for the last month. And today it rallied a little bit, but only 5 basis points, still going out above 130. I think there's a very reasonable chance to think that will be back breaking through the 140 level at some point in the next couple weeks. If we get taper news, if we get further confirmation of the Asian reopening, further confirmation of the Delta variant fading, I think rates only have one way to go. And by the way, crude has also been up roughly 4 weeks in a row, again, suggesting that there is a little bit of that growth, a little bit of that reopening, a little bit of that expansion trade. You know, people were sniffing it out. But every time it's the market is definitely like you start to move forward and then bam, you get hit and you go back and then you start moving forward again. And it's been this back and forth for months, which is why the equities have basically been chopping around, right? Bonds have not been able to get out of their trading range. The dollar's not really been able to break one way or the other. Commodities have big up moves and then they collapse. I mean, look at uranium most recently, right? It went from some of the ETFs, which we hold, thankfully we've been in position there, but I mean they've had 10-15% price swings up and down over the last couple of weeks. It's been really something to behold. But I do think it's important to note that Evergrande is one thing, the tactical outlook is another, and then the strategic outlook is the third factor. But we can bat around some of the tactical stuff before we go there.
Yeah, and talking about the tactical stuff, I mean, is it? I mean, can you elaborate a little bit more on the growth outlook? So, because of Delta, does it mean that I would say the peak in global growth has that been shifted from the third to the fourth quarter? And so far, and looking at the data, it seems that the only region that has not been affected by any Delta, led slowdown has been Europe, but the U.S. has. But now, the last, and it's always like this with the surprise index because it's kind of reversed to the mean. So U.S. have already started to surprise on the upside. So should Asia be the next line? While Europe is more steady.
Yeah, I mean, my view is that peak global growth already happened in the second quarter, right? Growth rates are decelerating. You had China growth rate peaked in the first quarter, year-over-year growth rates, right? And it's important to note that peak year-over-year growth rates does not mean the end of growth, right? It does not mean late cycle. And we've had this discussion already several times, you and I, but it's important to keep reminding people. So peak growth in terms of year-over-year change, first quarter for Asia with China, second quarter for the US, third quarter most likely for Europe, okay? But then we are moving into a more traditional growth cycle, I think, not late cycle. It's not as if we're going from peak growth to late cycle. We're going from peak growth to a more moderate, more traditional growth path, which is still going to be above trend growth. So we have had a Delta lull, certainly in the US. Q3 is going to be weak, and all the banks have marked down their forecast for Q3. Most have marked up their Q4. Several have marked up their 2022 because you're just pushing out the growth that's going to come from the inventory restocking, right? Which inventories are low across the board, whether you want to talk about, semi chips or autos or things you buy off the shelf in the supermarket, almost anything you want to mention, inventories are low. And so that's going to actually, what we've done is we've kind of pushed growth out. The growth didn't disappear because those inventories are going to be rebuilt. It just got pushed out. So now we have a situation where we're going to have global growth for 2021 somewhere around 6%. We're going to have global growth for 2022 somewhere around 4.5% to 5%. Both of those well above trend, right? So if you look at forecast growth for Europe for next year, it's at 4.5% growth. That's fantastic growth for Europe.
Yeah, for Europe.
And in the US, growth is going to be somewhere around 4 to 4.5% as well. So that's, again, well above trend. The developed country growth since the financial crisis has averaged about 2%. So yes, we're going to decelerate from 6 to 4, but that 4 or 5% growth is double what it's been for the last decade. And this is where I think folks are getting lost a little bit in the translation and having a hard time understanding that. But here's the real point, right, for investors: earnings growth. And I noted in my reading of the JP Morgan work that they just increased again their earnings expectations for next year. So they are now calling for $240 per share of earnings for the S&P next year. If you put today's close on that, you're at about 18 times next year's earnings. Not really very demanding multiple. And Europe's earnings are going to be great. I referenced a couple weeks ago, Bank of America's 1 year forward earnings indicator was talking about 30% global EPS growth over the coming year. And in that environment, I think stocks, notwithstanding a day like today where you get whacked and people want to stay away and they're really unsure, and you go down 1.5% to 2%, you have massive selling. Notwithstanding that, I don't think stocks are set up to have a big decline if those earning numbers are going to have any shot at getting at coming to fruition. And again, I don't think an Evergrande situation derails that growth story. That's the important point here.
Yeah, and since you talked about the growth rate for developed markets, being twice as high in 2022 as the average, for the last 10 years, we talk about this, several times, about the outlook for it staying like this for maybe another 3-4 years, or maybe even you have some productivity gains which will increase the sustainable growth rate. So that's and not in a day like today, but that doesn't seem to be even considered by markets, correct?
Yeah, no, I think that's right, and that's really the strategic framework that I'd want to talk about. We can either go into that now, but if you want to continue to
we can. Sure.
Well, why don't we'll just talk a little bit about emerging before we go into the strategic outlook, because we focused a lot on Europe and the US. And, we did add 2 emerging markets several weeks ago in our model portfolio. And the part of the rationale for that was this idea of Delta fading Asia reopening and the move towards a synchronized global expansion. Because while we've had peak growth, now the upside comes from all three regions. Remember our tripolar world focus, right? Europe, Asia, the Americas, the tripolar. All three regions potentially going forward are going to be in a synchronized, meaning together, expansion, which we have not had yet. Because when Asia was really firing coming out first of COVID in Q1, Europe was definitely not. In Q2 and Q3, Europe and the US were firing pretty well in terms of the economy, but Asia was not. The Asian lockdown story, which we've talked about over the last couple of weeks, Asia, broadly speaking, was locked down as tight in August as it was back in the spring of 2020. So now, finally, we believe we're getting to that point of synchronized global expansion. And that is going to drive the opportunity set in emerging markets, which have really been the big underperformers year to date, right? I'm sure after today, I haven't looked, but I would imagine after today, the broad EM equity indices are probably flat to down for the year. Versus ACWI up probably somewhere around 16%. So EM's been a big underperformer. China's been a big part of that underperformer, but as we know, Latin America hasn't done well, and Europe really hasn't done all that great either. So I think we're set up if that comes to pass, if the tactical positioning, Delta fade, Asian reopening, better data in the US, if that comes to pass and then rolls into a synchronized global expansion, then emerging market equity should do pretty well. And that's the bet that we made several weeks ago. It doesn't look great today, we'll be honest, down probably pretty much on every one of those positions. But, you know, we're not doing it for today. We're looking the next 3 to 6 months. And there, I think there's a reasonably good shot that that Asia reopens and starts to do well. China, as I pointed out, China relative to the US is as cheap today as it was in 2005. The last time it was so cheap on a forward earnings basis. Okay, so we've discounted a lot with China right now as we speak, right here today. Discounted a lot, in my view. And in Europe, we added to Russia or we initiated a position in Russia as a way to play the energy cycle in Europe, which I know you and I have talked about. Obviously, there are growing concerns about the energy prospects for Europe going into what could be a cold winter. Russia's the big provider of energy, natural gas to Europe, and so we initiated a position in Russia. So we now have positions in Asian ex-Japan, EM, in Russia, and in Latin America through ILF. And I think those positions are have real decent potential to perform pretty well over the next 6 to 9 months.
And Russia has done really well recently. And you know, I think you know, your call in Russia, you know, at least you know that has gone well. I mean, you did this a few weeks ago, and Russia has been doing well. I mean, you saw what's happening to the brands and everything. So you know, that's great. And now you know, if you want to go to the strategic, you know, more or less, I think there are some great expectations. Because, you know, and I'm asking this because it has to do with what we set up. You know, we just touched on the European energy crisis. There's a great expectation that, you know, maybe, you know, both Xi Jinping and Biden at the UN conference are going to talk potentially about some cooperation on climate. And you know, I just saw that Mario Draghi is going to really, you know, make a strong speech about the UN acting fast on this. So what's happening, you know, on the thematic climate space? And I want to comment on the article that you posted today about, you know, climate populism, that this is a risk coming. So is there, you know, so governments will have, you know, once again to step in and make sure that, you know, people do not have, you know, very expensive energy bills, you know, throughout this transition.
Well, there's a lot. I mean, there's a lot to unpack there for sure. But I think, look, I think one important point is that the idea that Europe is going to go back to kind of strict fiscal discipline in the next couple of years is highly unlikely given the energy environment and given the need to really move more quickly on climate. You'll recall that I initiated the concept of climate speed a couple of weeks ago as well, actually in my monthly, which is now, I guess, 3 weeks old, where I talk about the telescoping of time, right? Where climate change is kind of coming in our face so quickly that all of a sudden we've been thinking about it, talking about it for years and years. It's been in the background, but the summer of 2021, I think, brought climate right in the face of people in America, in Europe, in Asia, everywhere. And so it's telescoped time. And now we realize that we're only 8 years away from 2030, roughly. And 2030 is when the world is supposed to, according to the Paris Accords, right, get to peak carbon. And how do we get to peak carbon? We're going to have to change the grid. We're going to have to electrify the grid. We're going to have to change the sources of power to the grid. We're going to have to move from combustion to electric vehicle engines. All these things are going to have to be done, and they're going to have to be done fast. And so there's a lot of discussion around this issue of, does moving fast, is it cost money? Does it save money over time? And a lot of back and forth debate between the climate activist part of the community and the policymaking part of the community, not to mention the fossil fuel generating part of the community. And all these groups are going back and forth. But I want to make the point that I think what really struck me last week, and I wrote about it at a little bit of length in the Musings, was a report that came across my desk from the people at Pantheon Macroeconomics out of London, Ian Shepherdson and his team. They do very good work. And they wrote a report on the potential for a CapEx boom in the United States. Yeah. And what really caught my eye was they said the conditions were just about perfect. So when I hear somebody write who I respect and whose work I've followed for a long time, it's one of the benefits of having 30 plus years of being in the business. I know who I want to read and who I want to pay attention to in times like this. With Evergrande, yeah. I was able to reach out to people who are in China, who I've talked to for years, or in the case of Ian's work at Pantheon, someone I've read for years and years. When he says conditions are just about perfect, he's not, a guy given to, hyperbole. So I want to pay attention. And what he said was that, look, in the U.S., there's been a lack of capital expenditure by both public and private over the last decade since the financial crisis. At the same time, companies are cash rich. Borrowing costs are super low, and labor is tight. So these are the 3 or 4 conditions that lead him to say that things are just about perfectly set up for a CapEx boom. And he gave us the analog of the second half of the 1990s in the US, where you had productivity surge growing about 3% per annum. At the same time, wages were going up at 5% per annum. But because of that productivity surge, unit labor costs, which is what feeds into inflation, were only going up 2%.
2%, yeah.
And so that's really the golden goal, right? If you can have productivity growing that allows for higher than usual wage growth, so people feel like they have money, they spend money, the economy grows, consumption grows, and you do it without inflation, that means it's sustainable, that you don't need the Fed to come in and slam on the brakes and raise rates and end the story, which is how the story usually ends. Yeah. And so, I thought that was really interesting, and it foots very well with my view that there is a reasonably good chance that we can shift the developed market economies onto a higher growth path. And that's going to come about through 3 main factors. And I talk about this a little bit in the Musings. The first is the pro-cyclical spending of the Biden administration, or in Europe of the next gen plans that are being, spending that's coming right now as we speak, or in Japan as they look to add a new stimulus package with the incoming new government. So pro-cyclical spending. a CapEx boom, which we just went through, conditions just about perfect for a CapEx boom. Certainly, you think about a new government in Germany, there's going to be a lot of talk about digitalization, a lot of talk about improving the electric grid in Germany, a lot of talk about electric vehicles. Same in Japan, digitalization, critical in Japan. Same in China. So this is one of the things when you read about, like you look at graphs showing that China fixed asset investing is going down, or credit stimulus is going down, and so commodities typically go down. That's because for the last decade, the only people really spending big money were the Chinese. The point here is that going forward, all countries are going to be spending money because of climate. The need to get to net zero, or peak carbon rather, by 2030. So we're actually in a better place. We're not going to be dependent on China spending money unwisely to keep their economy and the global economy afloat. No, we're talking about a CapEx boom spread across the tripolar world in each region, driven by the need to address climate change and supported by a productivity surge that itself is being generated by first COVID and now climate in terms of adoption of technology. So you have pro-cyclical spending, public-private sector CapEx boom driven by climate, and accelerated adoption of technology driving productivity, all of which suggest that you can have developed economy growth better than expected, a new above-trend growth path unfold over the next couple of years, which is not really in anybody's discussion points for the most part. Mostly everybody's, because of Delta and the action over the last year and a half or so, everybody's focused very narrowly right in front of them, as opposed to thinking about what the opportunity set could look like over the next couple of years. And so for me, I think this is really exciting stuff. I think there's a reasonably good chance that it unfolds this way. And I think virtually no one is investing or talking about it as a reasonable likelihood. And that to me suggests opportunity. And then that's when you start to think about some of the thematic stuff, some of the climate stuff, and things that we've discussed in the past.
No, and looking at the title, I mean, it's the title of the Musings, this week. It could be adapted a bit, so it means that it's like the Prince, song. So very soon you're going to be partying like it's 1999, right?
Well, yeah, I mean, just remember 2000 was rough.
2000 was rough, but take that aside, yeah.
Yeah, well, the period 95. I mean, it's funny. I went back and asked some of the team here to look at the performance of ACWI from 95 to 2000, and then 95 to 99, because they're so different, right? When you include 95 through 2000, you encompass the tech bust. Yeah. And therefore, returns are still pretty good. I think ACWI was like maybe 12 or 13% per annum over that period, which is quite good. If you go from the beginning of 95 to the end of 99, ACWI is up 19% per annum, which is really good. And so,
yeah, those were the days,
yeah, well, right. And those were the days of CapEx boom, higher productivity, lower inflation, so you could have a growth cycle that really unfolds and isn't truncated by central bank intervention. And that's why this paper made such an impact on me, that I said I want to write specifically about this CapEx boom, because those are the things that can allow us to have above trend growth, which means above trend earnings growth, which means continued good equity returns. And by the way, this movement to above trend growth is what allows the central banks to get off the zero bound without busting the equity market, right? Because if we have a period of above trend growth with moderate inflation, then the Fed can gradually raise rates in 2020, and here we're talking 2023, 2024, 2025, gradually raise rates and give themselves some room to maneuver and get off the zero bound, which we should all want, right? We don't. It's not good for the central banks to be dealing with zero interest rates, negative rates in Europe, not having any room to maneuver. We want to see stronger growth. We want to see moderate inflation. We want to see over the next 3 years the Fed raising rates to 3% or something like that. Or not really 3%, but let's say the 10-year getting to like 3% and giving a cushion. And I think that only happens if we get this above trend growth, which comes from CapEx boom, which is going to be driven by the need to adjust for climate change. And again, that climate reality of every country in the world focused on meeting peak carbon by 2030, and that timeline, 2030, it forces the mind, it forces the action. And so this is not stuff that's going to be put off. It's going to happen. It's just a question of how it happens. And this gets back to the climate populism, right? And how quickly we move and then how governments react. And that's why I say one clear takeaway is that fiscal discipline in Europe, a la the way it's been since 2010 to let's call it 2019, pre-COVID, is gone. Is gone. And that's an important thing to keep in mind when you're an equity investor, because it means that you're going to see a government that's going to be more flexible because we're going to go through some very big changes. And for investors to understand the impact of climate, the impact of climate change, what that means for CapEx, what that means for opportunities across different industries is absolutely critical, I think, to being a successful investor over these next 5 to 10 years.
No. You make some great points, first, about the capex boom. I think, to some extent, it's right, because in the 90s, in the early 90s, you had the adoption of the internet. So maybe at first, people, economists in the market was underestimating the impact it had that on productivity, right? And now, it's the technology were already there, but you had the productivity boost, from the accelerated adoption of those technologies. So I think the analogy is similar, and I think also what happened at the time, and for us who were old enough, to work at the time, it felt great because everybody was having a piece of the action, as you said, right? Because the economy was booming, people were employed, they were spending, more. So it really felt great, during those days.
Yeah, and if you can get 5% wage increases, that's what is everyone worried about? Everyone's worried about, wage pressure. Everyone's worried about, it's hard to get labor. Wages are going up, so margins have to come down. Well, margins may come in a little bit. We're at record margins now, right? S&P record margin, 13% net. It's pretty amazing. But that has been accomplished for some part through the squeezing of labor. And so that's led into all the political populism we've had and all the things that have certainly not been pleasant. So if we're having an opportunity to kind of drive higher growth through CapEx and through productivity that allows for wage gains so that everybody feels like they're having a piece of the pie and therefore the economy is growing, consumption expanding without inflation, so the Fed doesn't have to stomp on the brakes. Remember, every bear market virtually, other than things that come out of nowhere, comes about because the Fed steps on the brakes because inflation has gotten too high. Productivity, CapEx boom, is what limits that risk. And that's why we should be on the lookout as investors for things that can support the case for higher productivity and a CapEx boom, because that's what gets us above trend growth without inflation. And that's what is really what we should all aspire to. And which I think, again, my point is not that it's a guarantee. My point is that the conditions are setting up for this to happen in a way that hasn't been the case for the last 40 years, arguably. Okay, I know we're talking about the 90s, so there was a period, but we are talking about going from small government to big government, and we're talking about, even more importantly, the tight window for climate mitigation and climate change. these next 8 years. That time frame forces the action. And that's why I'm saying climate speed, building off the COVID speed model that I introduced a year and a half ago, that was tremendous value add, at least for me, in investing over the last 18 months. Now climate speed, telescoping of time, and understanding that decisions we make in the next couple of months, particularly the prime example being the Biden infrastructure plan, the human capital infrastructure plan, which contains the approach to deal with climate mitigation in the US, particularly around the the electricity grid. If this does not pass in the next couple of months, then the chances of the US meeting its Paris Accord targets fall to virtually nil. That's another example of telescoping of time. We're talking about something that's 8 years away, but if we don't move today, i.e. in the next couple of months, it's not going to happen.
Yeah, and that's exactly what I was going to ask. I mean, what's your sense of the political environment in the U.S.? You have the debt ceiling, which was also something that affected the market this week. But most important, Biden's plan. We talked about this last time, and also today. You just said that people have to get used to big government, because there are some challenges that cannot be met solely by the market. I think this was, clear, with the vaccine last year. Well, it normally takes the 5 to 10 years. It took 1 year. And of course, there was, huge cooperation between government and private sector. So how, is the political environment, and, is there any, scoop onto what Biden is going to say in the UN tomorrow?
No scoop. So I have not really gotten any input into that. I think, look, my view has been that really since the Afghanistan exit, the Democrats will want to be able to have Joe Biden go out there and show that America continues to lead. And the way that America continues to lead is through providing vaccinations and vaccines. So that's happening, as well as leading on climate. And so I would expect that, notwithstanding all the sausage making, which, is never pretty, but is being played out, publicly in real time here within the Democratic Party, because the Democrats are negotiating with themselves. And that's why I said my first point was that the Democrats want Biden to be able to go be a leader and have America be a leader on the world stage. It's purely negotiating within the Democratic Party. Yeah. And so I believe that at some point that will come together, and it may not be the $3.5 trillion. I think it's going to be well north of the $1.5 trillion that has been bandied about on the other side of the equation. But I think, as I said, for me, the big thing to focus on is the climate related stuff, primarily, given the urgency of that. And that allows President Biden, not so much at the UN tomorrow, but at the COP26 summit in Glasgow in November, to really show leadership there. And hopefully, a really interesting geopolitical point is the U.S.-China relationship, which has to work together on climate if we're going to be successful as a planet, but is being challenged to do so when on many other fronts, that competition between the U.S. and China seems to be sharpening. So how those two things, tactics and strategy, maybe again, strategically, the U.S. and China must work together if climate goals are going to be reached. Tactically, U.S. and China are, skirmishing across a number of fronts, and this has been going on for some time, and is probably going to continue to go on. But how this gets handled, and then you have Europe in the middle, kind of playing the ref to some extent, or the third party, the interested third party. Is really going to be the story of the next decade.
Mm-hmm. No, absolutely, and it was not any school was something that I read or anything, but I read a lot of stuff, and sometimes it's difficult to remember where from. But it seems that there is the expectation that both Biden and Xi Jinping will talk about, okay, we're competing, and we have a difficult relationship on a number of other issues, but climate is going to be something separate, right?
Yeah, well, I
We
mean,
hope so. Yeah.
time will tell. I mean, I think as we've talked about before, the carbon border adjustment mechanism that Europe is contemplating, which kind of keeps surfacing in the U.S. I have to say, it does. There was some mention over the weekend of CBAM here in the U.S. China is, quite exposed to that because their current carbon pricing, which they're just getting off the ground, their own national emissions trading system, is, still way underpricing carbon. But you can see, even through the steel production quotas that we talked about earlier on the session here, they are saying we want steel production to not increase above last year's levels because it's very polluting. And by the way, we're hosting the Winter Olympics, and we want to have clean skies.
Yeah, the Blue Sky Olympics.
You can't produce more steel. We'll shut you down, or we'll do whatever we have to do to make that happen. And then you see that ripple across the mining space, and iron ore and copper, as we've already talked about, to the point where these things have really been smacked pretty hard. But I think ultimately, China needs to move forward on its energy plan. It is doing so on a number of fronts, and it will need to continue to do so, because I think there's going to be more and more pressure brought to bear on those groups that do not move forward on climate, whether it's individual countries or groups of countries. I think we're going to see significant pressure brought to bear on those countries that are not moving aggressively. And so whether it's through the CBAM, in other words, U.S. and Europe come together, form a joint CBAM, and everybody who's outside, who's not doing what they need to be doing on reducing their footprint, has to pay a tax. That's one way of getting everybody on board. I'm not sure we'll come to that, but I think those are the things that may not be talked about very much, but I'm sure China is well aware that CBAM is being discussed in Europe and the United States.
Oh, yeah, of course. And in the final minutes, I mean, we covered a lot of ground. So can you do kind of a rundown of the most important allocations? What has changed over the past couple of weeks? And remembering your Japan call did great. You still, is that still one of your favorites?
Yes. I look at IFA now as I did with the U.S. For the last year or so, right? I called it the twin engine market, growth and value, right? When rates went up, cyclicals and value did well. When rates went down, growth did well. Now in IFA, you have Europe having done really well for most of the year. Now, by the way, back to levels 2 months ago. Europe has pulled back all the way back to July levels, even though, as we talked about, earnings, valuation relative to the U.S., one standard deviation cheap. Europe has pulled back, so looks good again. And Japan has finally taken the baton. So there in IFA, you have the twin engine, Europe and Japan, both driving forward. I think Japan looks really good. This environment here probably allows it to work off a little bit of an overbought situation. I mean, it did go up 10 or 15% in the matter of a month or so. So healthy pullback there, but you have new government coming, a new LDP candidate. LDP will likely win the following election. Stimulus package to come, lockdowns to go away, cyclical exposure to an Asian reopening, activism, cheap valuation, under-owned. Foreigners have been net sellers of Japan equity year to date. So yeah, all those things continue to be in play. As I mentioned earlier, we did add to EM, both in Asia, ex-Japan, and in Europe via Russia. So we think that's interesting. We continue to own the cyclical and value segments within the U.S. So we have not made any changes since we updated our model portfolios 2 weeks ago. So we continue to be overweight equities, underweight fixed income, continue to think rates are going higher in the US and in Europe, particularly government rates, that is. We still feel okay with credit, particularly in the United States, high yield credit. Been no signs of contagion there, by the way, in terms of thinking about possible contagion across the credit space relative to Evergrande or other things. And very constructive on commodities. Commodities have arguably just broken out of a multi-year downswing relative to stocks, I believe on a 10-year rolling basis. The first positive reading for commodities in about 7 or 8 years. So that's compelling to us. And as we talked about, there have been very big pullbacks. And if we're right about a Delta fade, if we're right about an Asian reopening, if we're right about a synchronized global expansion, we will be right about commodities. And if we're not, we'll be wrong.
So we have to, yeah.
But I mean, I look at things like the mining stocks. PIC is an ETF that we are invested in. I mean, it's been bludgeoned the last couple of days, really sold off aggressively here. If you look at some of the energy space, XLE and AMLP, AMLP to me seems like a no-brainer. I keep wondering, what am I missing? 7% yield, dividend coverage of 2 times, valuation very cheap, and yet it's just sits there or goes down as it did today. So to me, a 7% yielding energy pipeline midstream play in the United States, I think is very, very compelling. So I think there's opportunities throughout the commodity space. And then thematically, we remain very focused on climate. Carbon, KRBN, was up today.
Amazing, was up today. I just saw,
yeah, and that shows you that A, people don't want to sell it, and B, people are looking for things to buy in a sell-off. And so KRBN, we continue to like. It's the single biggest commodity. It's the single biggest position in our TPW20, our thematic model portfolio. And climate remains the single biggest segment of that TPW20. It's about 28%, 29% of that model is purely climate focused, whether it's carbon or uranium or electric vehicles, et cetera, many different ways to participate. So we remain constructive on that thematic space as well.
No,
and maybe one thing that would be good to, because I've been asked this a couple of times today already, what would convince us or me that we're wrong and that we need to significantly.
It's always a good question to ask yourself.
Yeah, exactly. Well, and I asked myself, and I had others ask me as well today for sure. So for me, though, I go back to those 3 things that I've talked about a couple of times already. Is the Delta argument, Delta fade? That's step 1. Could we be wrong on that? Step 2, Asian reopening. Could we be wrong there? And step 3, synchronized global expansion, which comes from the first 2, obviously. Could we be wrong there? And those are the 3 things that I'm looking at, not Evergrande, because I think Evergrande is today's action was kind of crazy to me relative to what Evergrande really means, I believe. It was an opportunity for people to sell and they took it. Fine. That's good. So for me, I think Delta fade continues to be playing out. There's no real variant besides Delta coming down the pike. Nothing anywhere near as aggressive as Delta. The Asian reopening, I think, is on par, on play, happening as we speak, and watching and paying very close attention to it. And then third, the synchronized global expansion comes out of that Asian reopening, because the US is not going back into lockdown. Europe is not going back into lockdown. And so I think those are the 3 things I'm watching. But minus any of those changing, we continue to be constructive on a 3 to 6 month basis.
No, I agree. And of course, jokes aside, but so let's enjoy and party like it's 1999. So,
absolutely.
Yeah, so it was great. Thanks again, Jay. There's a lot of received a lot of good comments, and actually someone sent me the actual study that you mentioned about the productivity growth. So I'll of course I'll read it the next few days. Thanks again, and we'll stay in touch, and I'll see you in 2 weeks. Thanks very much, and thanks everyone for attending.
Great, Roberto. Thanks. It was definitely a challenging and interesting day, but I think we covered a lot of ground, and hopefully,
we did.
Found it helpful. Till
Thanks
next
very
time.
much. Bye bye.
Bye bye.